Hi everybody, we're going to get started in about a minute, so come on in, make yourself comfortable. Thanks for coming along. Hi everybody, thanks for joining us. We'll get started in just half a minute. Thanks for joining us, make yourself comfortable. All right, I think we've got most people here, so we'll kick it off. Thank you very much for joining this month's webinar on making the most of record low interest rates. I'm really excited to be joined by my business partner, financial advice and lending guru, Jules Knox. Welcome along, Jules.
Sure, thanks for having me.
No worries. So just like to let you know at the outset that Jules has a throat condition that she's dealing with, which means sometimes her voice does fade in and out. So if any point her voice does go, you'll either have to put up with more of me talking, or please type in the chat box if you have any questions you'd like us to repeat on those, but hopefully we'll make it work.
It hangs in there.
So for today's webinar, you'll be on mute and we can't see you on video either. Having said that, we would love to get questions from you. So if you click on the Q&A tab where the tick is there and type in any questions you have, we'll get to those either throughout the webinar or we'll come back at the end of the day and circle back to those. So please do fire away with questions or comments. Most of our conversation today is going to be about general lending strategies and the broader sort of economic environment. But I'm going to provide you with a general advice disclaimer, which says that even though most people on this webinar are clients of Evalesco, we're not considering your personal circumstances today. So what we're talking about is general advice only. And if you would like to know more about anything or see how it does apply to you, please get in touch with Jules or I or your advisor after the session. We're also going to make the slide deck available for you after the session in our newsletter. Next week, we'll have the recording as well. So this is what we're going to run through. As you would have seen on the invitation, nothing has changed too much since then. We're going to go through the top tips for making the most of record low interest rates, talk a bit about when interest rates might start going up, why and when you should fix a loan, and what's happening with bank approval process. So without further ado, we'll get straight into it. So Jules, over to you. What are your top tips for making the most of these record low interest rates?
Well, Jeff, really for clients that have got existing loans, there's certainly things they should be doing year on year anyway. The fact that right now it's a really good time to be reviewing and checking if you're paying actually amongst the lowest rates. Certainly good deals getting out there. This graph shows, though, that obviously rates have been progressively coming down in the last couple of years. So everybody likes to see this graph because especially if you've got debt, feeling pretty good about paying pretty low rates already.
Yep.
However, it does show that existing loans generally paying higher rates than new loans. So if you've got existing debt, basically what you want to be doing is moving from one of those top lines, which is either owner occupier investor,
yep,
investor being the higher one, and then owner occupier, and trying to move it down into what's currently new borrowers are getting. So yeah, so I guess my first tip is to shop around and try and get a better rate on your current loan.
Yep.
And having said that, by all means, ask your existing lender. You can do. We do this for our clients anyway, year on year, just make sure we're pushing back on their existing lender. And it does actually help that we're brokers, because sometimes they pay a bit more attention to us as brokers, knowing that we will with the client if they're not getting a good deal. So feel free again, if you're a client of ours, reach out and can go into that for you. If you're existing lender, and again, still as much as we push, they don't always match what the other potential lender able to offer.
Yeah. So we still find that typically the banks won't necessarily pass on all the rate reductions or pass on the same rate to an existing customer as they would a new customer, even if you do ask the question. So there's still sometimes a gap, as this reasonably busy slide bears out, but hopefully you've got a chance to sort of go through that. So I think the key question comes back to the old adage: if you don't ask, you don't get. So going back to your existing lender, but also regardless of that, refinancing usually results in a better outcome.
That's correct.
In this current market.
And it's much easier than it used to be. So, you know, it used to be exit costs, used to be, you know, kind of hassle.
Yeah.
But now, clients find that, that's actually easier than I thought. Feedback. And obviously that's where we're here to help and make sure, it's as possible.
Yep.
And you're not paying too much.
That's good.
This is just a key point I want to raise around that. So, as I just mentioned, this point is new loans, the best rates. So, you know, try and push, but shop around basically is the best way to do it. And second point is, so like clients, excuse me, I'll have a drink. And a lot of our clients have been working hard at paying off their loans for a number of years. So potentially, you know, while prices are going up, is what's happening is the loan to valuation ratio is going down. Again, you might have got your loan when it was at 8% LVR. Now your LVR is possibly lower, and the lower your LVR now, the lower your rate fee.
So the banks are taking in a risk factor effectively. So if you've been a good customer, you've got more room in your loan, so if things go wrong, they've got more buffer. So they're going to reward you with a lower rate, which hasn't always been the case. That's a reasonably new thing that they've sort of brought in the last few years. So that's another good example of where refinancing makes sense, because if you've had a loan for a period of time and you've made some progress on that loan, you're now potentially a better customer, as well as going to a new bank who's looking for new business can reward you for that as well.
Correct. So to a new property evaluation, say, wow, you've got a good property, we'll take that on as security, and you've got a loan, I'll get you for that. So that point is just package loans. So sometimes advertised, see the basic loan, and basic is what it is. It's basic. So they may have the lowest rates, but comparatively, it might not be the best rate for you, because you've got savings in offset, and you're not making the most of those savings, using those to reduce your loan on which you're paying interest, and you're probably going to be paying more interest with a basic loan than what you would if you're on a package. Again, it just depends on your loan size. So if we look at it, I think your loan's big enough to justify the fee of the package, but also benefit from the offset, then it's usually a better way to go. And I guess what we're seeing in Sydney is most people don't have small loans. So, you know, it's, I mean, good if you can, we want to get you to that point, but usually when we're looking at these kind of numbers, usually package loans out best.
So that sort of flows on to the next bit with the different options that are available with the packages and the different structure of loans. So again, you know, if clients paying for a credit card, you know, fee attached to it, they might have, you know, other savings accounts that are, you know, potentially paying them pretty, you know, terrible rates of interest at the moment. And if we actually look at the whole picture, potentially package that up, have the credit card included, savings obviously effectively at the home loan interest rate, which is, you know, basically an offset, and paying a low fee going. Some lenders are, you know, waiving fees. So again, you can look at
So don't assume just because you're getting more, pay more.
Yeah.
Sometimes you can actually get, quite a bit included for a nominal or, no fee.
And that's, again, worth looking at. The different lenders will have different options, and worth shopping around for one that suits you, but also provides the best value. Best value,
So refinance rebates, or, lenders from time to time offering money to get your business. So you can move banks and it doesn't cost you anything, or potentially you're going to profit sometimes from moving banks. That's a bonus as well. But again, don't get caught up by that refinance rebate alone, because again, it looks good. The bank's give me $2,000. I, change over.
Yep.
But after the year, will you be better off paying, move it to another lender that maybe you have to pay your own refinance costs and interest saving. These savings may be justified, going elsewhere rather than just going for the front cash.
Okay.
The last point is about fixed loans. Again, we have clients come to us and say, "Oh, I don't want to refinance yet because I've got a fixed loan, or I can't refinance." So they think just because you've got a loan that's fixed that you're locked in. Well, you are to some extent, and there are some break costs associated with moving at a fixed rate. But there's been a number of instances where we've seen that those fixed loan break costs are more than recouped in the first, 6 months to a year of refinancing, and then you're going to get the next, potentially 5 years of gains. So, again, don't assume just because your loan is fixed that you shouldn't even bother. Talk to us, talk to your lender, find out what the break cost is, and then we factor that in and do the numbers, see if it's worth it.
Yep. So what I'm taking out of this slide is that best rates are certainly available by refinancing, but there's a lot of other things that then go into the consideration and working out which is the best refinance option for you. So it's about looking at, is your LVR favourable? Does that mean different lenders can look at it better? It's the packages, it's the different things you need, whether it's offset accounts, credit cards.
Yep.
If there's a refinance rebate available and everything else stacks up, that's even cream on top of the cake.
Correct.
And if you've got a fixed loan still, let's have a chat about it and see whether it might be worthwhile.
Yeah, sure. That's it.
So I've got here a case study that you put together, Jules, with some information on what, I guess, a loan you've just recently done for a client. So if I run through the existing sort of structure.
Yep.
So the client has a fixed loan where they were paying 3.99% and they were making the minimum repayments on that. Had a variable loan portion as well, which is a smaller portion, and making minimum repayments on that. So the total loan was $700,000 with repayments of just under $3,500 a month.
Yep.
They also had a savings account, which wasn't attached to the loan, with $33,000.
Yeah, and a few different ones actually.
Okay.
So total savings, and I'm trying to, chase best rates on those accounts.
Yeah.
As I said, good luck currently and trying to get some good rates on savings. But so what we did is, obviously I got the client to ask their bank what their rate cost would be straight. Put that on calcs around the new lender fees, the discharge fees, tally that all up, and in their case, also did a refinance rebate of $2,000, which didn't go all the way to covering costs because they did have that rate cost in, but effectively the refinance cost to them rebate was that $492.
Right.
So there's cost there, but if you look at the, what they've moved to, so they've got reduced their average rate down from 4% to 2%. So it's pretty significant, massive interest rate. certainly RBA doesn't drop 2% in one quarter,
No.
one go, do they? So what we do here though is because the clients were making those repayments of 3,000, you know, 3,500 a month, and comfortably making those repayments. So they were happy to keep making those repayments. But now with the new scenario, they're effectively making extra payments of $875 a month because they're paying that much less interest. And the savings accounts can now be all linked as offset accounts. So still got their savings account, you know, structure in place, but it's just, yeah, saving them now on interest rather than trying to get, you know, 1% if they're lucky on their savings.
Yep.
So yeah, so that's again something that's quite that's a recent example and quite common to see, you know, savings in that vicinity. Flowing from that, it's just a quick calculation, but just in summary, what it shows is that the client in the first year is front by $13,800. That's after the cost of refinancing. Then after that, they're in front of about $14,000 a year. So yeah, obviously that $14,000 is the case going towards the home loan to pay off sooner. But yeah, again, speak to your financial advisor because they might take those savings and put them into investments or super, or depending on the, you know, the client's goals. It might be. I love it when we can take money from the bank and put it towards clients, you know, own wealth creation, not the bank's wealth creation. So
I think the key there is making sure you capture it and have a plan for what you're going to do with it, because it's great to reduce your repayments, but then if that money just gets frittered away, you're not really making as much progress as you could. So this is maximising the benefit of those savings.
Spot on.
And so that's also where on the previous slide you looked at the variable loan amount was a bit more than when the old structure.
Yeah.
And that's because there's going to be more going into that variable loan.
Correct.
To pay that down quickly, and you get penalised for paying down a fixed rate loan. So you want to make all additional repayments into that variable loan and smash that one down as quickly as possible. We're going to talk a bit more about that.
Yeah, getting that split right is important too between fixed and variable.
Yeah. So that's a really, you know, really concrete example. It's a pretty, I guess, stock standard example for clients that we see. A lot of our clients, you know, owning properties in Sydney, your loan balance around that amount is not too uncommon.
Nope.
So that's a real life example of one that you've done recently, which is great to be able to show everybody.
Yeah.
So as I said, if you've got any questions, then type them into the Q&A box. We're happy to pause and take those as we go through. But otherwise, we'll keep moving. So the other opportunity so we've talked about tips for making the most of record low interest rates for people with existing loans. Now for the first home buyer segment who are looking to get into it, so how can they take advantage of, I guess, record low interest rates, but also maybe some recent changes and things that are going on in that space?
Yeah. So commonly, what we hear amongst first home buyers is that they are struggling to come up with a deposit.
Yeah.
Right. So, just saving, but their savings rate is not the case with the, property growth. Yeah. So, there's a few ways you can try and get in sooner. I suppose what I want to show here. So, first home loan deposit scheme recently announced budget to be extended, and more places to be available.
Yeah.
So what that is basically the government's guaranteeing 15% deposit. So they're saying rather than having 20% deposit, which is typical, the bank requires, they're saying, well, you only need to have 5%. And so, but they still have to have the borrowing capacity.
Yeah.
So they still have to be able to show for the loan, 90%. And with that scheme, there are, some hoops to jump through. So it's a bit of eligibility criteria. So which is probably where most of our clients, and I've done one of these and I've attempted to do a few of the others, but the property price they're looking at just doesn't fit the bill. So property price maximum for the scheme is $700,000 currently in Metro New South Wales. So yeah, that's probably
hard to find.
It's hard to find, and again, depending on where you're looking, but there certainly could be those there's clients that are looking to buy in that price range, and they should look at the scheme if they don't deposit. And there's also some income tests as well. So just to be aware that, just talk to your, advisor, and we can make sure, we check your eligibility first, and then, it's an option. So the second option is family pledge loans, or family guarantee is another name for these. So if you've got a parent or a family member that has equity in their home, they can use that equity to provide additional security for the loan. So effectively, the first home buyer, or you don't have to be a first home buyer to access these schemes. So, effectively you can borrow 100% of the property plus costs, stamp duty and everything. I'm questioning, why they don't have any savings, because I think they should have some savings before they go in to show that they can save, because obviously if you're going to go and borrow, $1 million for a new property, you want to know that you can make those repayments and the bank would as well. So, but it's a good option for those clients that have got, they want to help out kids, but they don't have cash to give to them, or so it's not a way of getting them in sooner.
And the benefit of the family pledge loan structure is that the family is only exposed to a small portion of risk, so they're not exposed to the whole amount of the loan. So you might say, well, we want to provide the 20% deposit as security. So if it's $1 million purchase, you're effectively taking a loan out or putting a mortgage on your house for $200,000. The rest of it is on the home that you're buying. And we would normally recommend that that $200,000 is the first portion that's effectively paid out. And as soon as you've got that much more equity in your property, then you can release that as security so that the family gets comfort back.
Spot on.
And helping. So it's a good strategy. It's something that we're talking about more and more with people, because as we talked about, property prices are kind of running away from people trying to save that deposit. 100% agree that you should have some savings. If you haven't got any savings, then you're probably not trying hard enough. And again, back to your first point, is that you need to be able to repay. So the bank needs to, from a serviceability viewpoint, you still need to be able to borrow the whole lot.
Correct.
And the bank shows that you can repay that as well. So
spot on. And the last point there is LMI, or Lenders Mortgage Insurance Loans. So typically probably the least popular. So no one likes paying insurance premiums, as we know, and this is not insurance for you, borrower.
It's the worst kind.
It's the worst kind. It's insuring the bank's risk. For loans that are above 8%, so above 80%, you will pay typically LMI if you don't have a family pledge. But more and more, again, it's worth just looking, instead of assuming the 20% deposit is what you'll need, you might just want to start looking into whether paying LMI is going to get you into the market. So just as an example on this one, if you're buying $1 million property and you're borrowing, say, $900,000, which is 9% LVR, you pay about $18,000 in mortgage insurance premiums. So that $18,000, is an extra cost that you have to bear. So obviously,
that's on top of stamp duty and
all of the other
costs.
However, if that $1 million property was to go up by 4%, which is kind of an average, long term, not at the moment, they're going up well in advance of 4%, but we'll assume the average 4%. Then obviously that's the end of the year. That property is now worth 40,000 more. So your 18,000 you paid in mortgage insurance has been, more than offset by the increase of property. And obviously, if you were to wait to buy that same property, try to keep saving 20%, then that property is going to keep getting further away. Yeah. So, and again, at current low interest rates, to put that into perspective, that extra mortgage insurance cost, if you were to add that to the loan, might cost you about $400 a year in interest. So it's not a big cost, and I'm pretty sure you can, find $400 extra a year to cover the cost of that extra, loan amount.
That's great. So, if you have a family pledged loan, then you can have extra security. You don't need to worry about, that's more of a security position. You don't need to worry about an LMI loan. Yep. But if you can get up to a 10% deposit or something around that, then it's worthwhile. Then the numbers can start to add up and make sense.
Definitely. Yeah. So the last point to make is just not so much about making, the benefit, I suppose, of current interest rates. I just wanted to add on to this point that if you are thinking, or you've got a, one of your kids that are saving, madly for their first home, there are good savings incentive schemes. The government's recently, they did reinforce again in the last budget, and they've kind of expanded on this scheme, especially for single parents, single homeowners trying to get in. So what we want to be able to do is talk to people about saving super, to be able to do, obviously, instead of saving after-tax money, which is always harder to save, potentially saving pre-tax super, and then boosting that available deposit when you're ready.
Yeah. So you talk about that as a longer term. Is there a time frame you think that it makes sense to consider that as a strategy, or?
Well, you're probably thinking a few years at least, depending on your income and, current situation as to how much.
Especially starting from scratch.
Starting from scratch, that's it. So, but even if you've got some savings, like sitting in, a low interest savings account, and thinking about, maybe buying this home in, 5 years or so, you might want to put that in to super, hopefully with some good investment advice. You'll be earning more on your money, and most of the tax rates you're getting on that too.
Sounds good. Great.
All right.
That's first homeowners, first home buyers, big opportunities there as well in the current environment.
Yep.
So the next topic we want to talk about was when we think rates will start going up. So I'm going to have a bit of a chat about this, and the short answer is now, and they've already started to a degree. So in the last couple of weeks, we've seen a couple of the major banks have put their rates up for fixed loans. So starting with fixed loans at the moment, and some of them have gone up by, say, 0.2%. And the key reason for that is basically the RBA has provided they call it a term funding facility to the banks off the back of the pandemic and economic conditions, and the government wanting to support the banks. So that term funding facility was for a stack of money, 180 billion, 200 billion, something like that. And so the RBA has effectively lent that money to the banks at a rate of 0.1%. And that facility stops in June this year. So from then, the banks have to go back to their more traditional funding methods to raise the capital to lend out to them. So that's a really key turning point. And we've just seen, I think it was early this week or late last week, Westpac have come out with a new bond issuance for 5 years and 10 years, which is their traditional way of raising money. So they're the first of the big banks to come out and do that. So what that means is their cost of borrowing, so they have to pay more to investors than 0.1% to get that money. So their cost has gone up. So their rates, they'll lend it out, will also naturally go up. And I think in the main, the banks see this as a good thing. They're back in control a little bit of their cost of funds as opposed to having it being artificially low. So that's going to be coming more. All of the banks will have to do that at some stage in the next couple of months. And, it's already started. So we're seeing rates will go up. So that's going to affect fixed rates first because they've got to lock in a term for that money. But the likelihood is variable rates will be impacted at some point in time as they start to look at the mix between fixed and variable. They start to look at investors versus residential. And then obviously the variable rates are more influenced by the RBA. So if the economy starts to recover, if we start seeing employment back to levels they're comfortable with, if we start seeing inflation start to kick in, then that will have an impact on the variable rates. So that's happening in the States. They're talking about it in America. Inflation is a big concern for them now all of a sudden. So, you know, on one side, that's a good thing. It means that people are spending money and the economy is recovering. So that can be good for investment markets. But if it gets too much, then that becomes a drag. So they might look at putting interest rates. So they're talking about probably over there, you know, variable rates will go up sooner than here because inflation's already kicked up, but we're starting to see a few, I guess, green shoots of that. So we think interest rates, well, they are already starting to go up on fixed rates, and variable rates may follow later this year, early next year. So worthwhile thinking about fixing while you get the chance.
It is. Good time. Now's the time.
Yeah. So the answer is now.
Yes.
to that question.
Quick answer. Yeah. Now, but within, you know, reason. So obviously we talked about, you know, there's some downsides to fixing, especially if you're on a mission to pay off your loan quickly. And so it's about getting the right mix of fixed and variable. So variable gives us a lot more flexibility. We might pay a little bit more at the moment. So the differential might be about like %, say, on between a fixed and variable. But if you've got offsets working for you against that variable, again, if you've got cash and savings, and we always recommend you have cash, don't we, Jeff, to make sure you've got some buffers there for emergencies. So, available cash should be offsetting the variable loan. Plus, what we try to do fixed and a variable is to give clients focus. So if you've got, as we know, if you've got one big amount, say $700,000 loan, you look at it and go, oh gosh, when am I ever going to pay that off? You know, it just is a big number. So like with anything, the psychology of, you know, trying to do things in smaller chunks, and we do apply that with fixed and variable strategy. So break off a big chunk into a fixed rate, lock it in nice and low, pay the minimum and just let it, you know, let it stay there. But you've got a variable loan, potentially be really focusing on paying extra too. And then ideally, what we try to do is pay, you know, as much or close to, you know, the variable loan, whole, you know, loan in the fixed rate period. So then you get to the end of the fixed rate and it comes off and we do it again. Split it depending on what rates you're doing at the time. We, you know, we may less because obviously rates have gone up. We might not want to put it in, you know, quite as much depending on what it's doing. Right now it's really the strategy.
And that's the key aspects of that are thinking about your plan and your strategy. Have a strategy that suits your time frame and your budget. You can't have an offset against a fixed loan. So
there are lenders that do it, but they're generally at higher rates. Still restrictions.
And you can't pay as much additional off a fixed loan. So you know, you pay as much as you like off a variable loan with most lenders in most loan structures. So that's why you So on the next slide, we've got a nice, Jules will call it a simple scenario. It's a busy slide for a structure that makes sense when you're talking about, you know, when you should fix. And just before we go to that, I just wanted to sort of point out as well, even though fixed rates have started going up, it's not across the board, but they're still super cheap. So if you haven't fixed your rate, you haven't missed the boat. Still, you know, if it's gone up by 2.2%, still record lows, and still now is a good time to get it.
Correct. I think that's a common mistake people make. See fixed rates going up, so they don't fix, you know, and then they think, oh, you know, hopefully they'll come back down again. Well, probably, you know, won't from what, as you said, all the things we talked about as to reasons why. So you haven't missed the boat. Just talk to us about right split. So this, simple. It says sample loan structure, not simple, but it is just an example where clients got their own home and also an investment property. So they've got their own home, securing their home loan, split between fixed and variable. Yeah, your own. So it's color coded. Did you pick up on color coding, Jeff?
I did, absolutely.
So the red is highlighted here is what we call our bad debt. So we still need debt to buy a property. So it's not bad to borrow, obviously, to buy your own home, but compared to, say, investment debt, which we consider is good debt, then helping us to grow our wealth, and there's tax deductions available, which is what those orange boxes are for the investment loan up there. So that's, and then the green is the investment assets. So, we've got our lifestyle assets being our home and actually our savings accounts, things for our holidays or bills and things like that. But it's just really about structuring to use the bank's products, fixed rates, variable rates, the offsets, to your maximum advantage. So it's just and it's not, once it's set up, to be honest, it's fairly set and forget. It's just a bit of, again, getting the right splits, getting the best rates, getting it all, place, and then it just flows quite. And most clients really love having structure. They see where their money is, and they know they are focused on paying that variable loan off first, and then that's directing the extra payments. But in this current environment, as I said, we've got really low rates, so we don't want to be just paying home loan debt, which again is often the default, which is not bad, but it's just that could also be, making our money a bit harder. So that's where we use some of the investment debt investments in this, example, to do a bit of both, paying off the loan, so be getting ahead, investing and benefiting some of those good property gains and share market gains that we've been seeing. So
So I think the key to this is for me where the value of advice around lending comes in. So it's easy to look at the headline rates and see which is the cheapest rate, as you said before. The cheapest rate isn't always the best. You can get a really cheap rate, but if you've got a really bad structure, you're not going to be as effective if you pay a little bit more. You shouldn't have to pay a little bit more, but if you do have to pay a little bit more, and with the right structure, it's going to accelerate your, achievement of your goals. And the goals are different for everybody, but typically paying down your home loan is a pretty key goal that most people have. It's going to accelerate that, but also then give you the opportunity to, as you said, Jules, build some wealth outside of the home, which is really important as well, because just paying down your home is a great goal, but it's not going to end up allowing you to have freedom or a good retirement, because you've got to have some assets and some passive income, and you want to build that up as well. So getting a structure like this, looks complicated, not simple, but a sample, is really valuable, and something that we see as being a really important part of our role when clients.
Big difference.
So if anyone has any questions on that, we're pushing up towards time, so we'll keep moving, but please do fire away with any questions we haven't even come through yet. We'll move on. So the question is it hard to get a loan these days? And you made a good point earlier, Jules, about talking about refinancing. It's usually not as hard as people think it is. Certainly the case. We do know that there's always, banks go through ups and downs, as everybody does, with their, effectiveness and their processes and how things turn around and their policies. There were some really strict things changed in regards off the back of the Royal Commission in regards to serviceability. There's now some starting to unwind some of those and some backtracking from a few of those things. So what do you think? Is it hard to get a loan these days, or how are the banks processing things?
It's not harder, but it's probably slower, especially right now with the current property market. So probably an example there is if you're buying the current market, it's not less likely that you'll get a loan. but there's probably a few more, just time considerations to build in. And also approvals. So again, a lot of clients say, oh, we want to get approval in place before we go shopping. And probably a lot of that's come from historically the bank's marketing, saying, you know, come see us, you can get fully approved before you go shopping. Well, you haven't seen those ads lately, have you? Because the banks aren't doing full pre-approvals at the moment. They're too busy, effectively. So what they'll do, they'll tell you you can get an approval, but it's pretty much just a computer-generated approval. So it's, you know, whatever data, you know, you tell them, they'll go, hey, yep, you should be able to get a loan. There you go, shopping. But again, that comes with risk, because you can then apply for a loan when you find your property and, you know, sign on the contract. Then you've got to go through the full application process. So again, please use a broker or come and see us, because don't go buying on a bank's, you know, kind of computer generated automatic approval, because they haven't done a full assessment on your position. And there is inevitably, in most occasions, there's always some of those unexpected surprises come up along the way. But in self-employed clients, again, you know, same as usual, they have to go through a little bit more of the, you know, the arduous task of, you know, getting their returns in order and planning for a loan. So again, self-employed, thinking about, you know, buying or trading, talk to us, put a plan in place, and we'll make sure you're prepared for that loan.
Okay. I think talking about the turnaround times, we've seen some ridiculously slow turnaround times from some banks. So I think one bank who I won't name, but I think you were saying it's 8 weeks before they even look at your file or something like that. It's
one of the major big fours. So yes, it's ridiculous.
So yeah, we do expect things to be slower. So it's good to have a plan. But just I guess I wanted to use that as an example. There's been a lot of talk about I guess investment fueled, you know, property price rises and the market's overheating because of investment. But what the banks are telling us and all the statistics are saying is that most of the loans at the moment are for owner-occupied. There's not really been an increase in investment loans. And a big driver of that is, I guess there's a few big drivers, but there's, you know, interest rates are so low, which is great. So for some people, it's cheaper to have a loan than it is to pay rent. I think there's probably a lot of us spent a lot more time at home over the last sort of 12 or 18 months and realising, well, if I'm going to spend this much time at home, maybe I could have a nicer home. So people looking to upgrade. So there's people out there doing that as well. And, you know, I think there's also been a bit of pent-up demand from last year where people were locked down. They couldn't go out and see a home. So
listings,
so there was less listings, and if you're going to buy a home to live in, you probably want to see it. Whereas if it's for investment, maybe you don't need to see it as closely. So I think those things are what's really driving it. And then, you know, that means the banks are busier. And so it's slower turnaround times. But it's not because investment markets are going crazy. In the main, there might be some areas and some pockets and a little bit of that, but in the main, it's owner-occupied.
I'd agree with that, even just from our experience and what kind of loans they're doing. It's more of those upgraders. Client called me last night. Hi, Amy, if you're watching. And again, clients now have been thinking about this for a while. But and also if you're buying and selling current market, it's actually not a bad time to upgrade anyway. You're finding that your property is now worth a lot more than it was. So and again, we can work out all the costs and figure out what you need to do, and then obviously find a lender and that's going to give you the best outcome and hopefully get your loan approved. But just please don't sign a contract with a 4-week settlement. Again, just one of those, and it was tough to get that all through on time. We got there, but
hard work, stressful days for everybody.
Stressful for everybody. So 6 weeks settlement minimum, and then if you're buying, selling, you might negotiate longer.
Okay. Seeing, is there any questions that anybody would like to ask before we wrap up? Because we've pretty much come to the end of our formal portion. Is there anything else you wanted to add, Jules, that we didn't get to in the last sort of 2 minutes?
Covered everything, but yeah, probably just key takeouts that, yeah, now it's time to look at your loans. Please reach out to your lender or to us, and because it is something I get particularly excited about, as you know, Jeff, when I can see that we're making huge differences to the client's position just by taking money off the bank and directing it to what, you know, is important to the clients. I love it. I really do. So by all means, yeah, talk to us if you want to try and, you know, look at how you can, spend less money on interest and more money on the things that matter.
Great way to finish. Thanks, Jules. So as Jules said, if anyone has any questions, please get in touch with your advisor or Jules and I. There'll be a recording of the webinar coming out in the newsletter next week, along with the slides as well. But thank you very much for coming along and listening to us, and hopefully we added some value, and look forward to seeing you next time. Thanks, Jules.
Jeff, bye all.